Now, US valuations are pretty crazy at the moment, particularly in the tech sector, as we all know. But for the broader market, the so-called cyclically adjusted PE ratio is also very high. It's about the highest level it's been since the year 2000. It looks very rich in the context of very sharp slowing earnings growth. And I think that earnings growth is actually possibly going to go negative for reasons I'll talk in a second. However, there are positives in the US. It's gone from a large energy deficit, as we know, 4.4% of GDP, to one that's only about 2% today and is likely to go to 0 in the future. And if the United States allows the shale oil companies to start selling overseas, then it could be in an energy surplus in the relatively near future. Onshoring of production, i.e. the bolstering of manufacturing, is happening in the United States, although not to the extent that you might read about. And there is a lot of slack in the US labor force, where the participation rate has been falling for quite a number of years, and therefore there's capacity to hire workers without generating wage inflation. However, there's still a low savings rate in the US. The housing recovery, which was the bolster for the economy last year, is faltering a bit. And there is definitely a lack of skilled workers. They have not trained their population to the same extent as even the Europeans and we in Britain have, and they're certainly seriously short of various skills in the US. Now, if you look at this chart here, you can see that earnings growth in the US is actually declining. And the only reason that it's still marginally up is because of share buybacks. Now, the share buybacks, so 2 years ago I talked about how US companies were stuffed full of cash. Well, what they've been doing in the last few years is using that cash and indeed adding to borrowings, and contrary to what you might read, the US level of corporate debt is at an all-time record as a result of this, buying back their stock in order to shrink their capital, boost their earnings per share. It's financial engineering on a grand scale, and it's being encouraged by these rather horrible activists like Bill Ackman, Carl Icahn, who basically go in and effectively asset strip companies for short-term gain, companies which could have used that cash to productive investment and are paying it out in the form of share buybacks, which make some tax sense in the United States. And it's flattering earnings at a time when actually fundamental earnings are declining. So I'm not particularly bullish on the US, and when you actually look at this, which is the boom in the sort of stocks like Twitter, Facebook, the Just Eat sort of nonsense that we've seen going public relatively recently. They're not nonsense companies, but they're at nonsense valuations. You can see that there is a bubble out there, which is equivalent to the bubble of the year 2000. And I honestly believe that there's only one way for many of these companies to go, and that's down. Now, remember Polaroid, remember Xerox, remember Kodak. These were the go-go companies in the 1960s with unbelievable growth ahead of them. As recently as 2000, Nokia was one of the world's most capitalized companies, and on Friday, that's yesterday actually, Nokia sold its handset business, which had been the mainstay of its business, to Microsoft for 5 billion euros, which was a fraction of the peak valuation it achieved in 2000. The creative destruction of technology is enormous. There's no reason why Facebook should still be so highly valued in a few years' time, or indeed LinkedIn, or indeed Tesla Motor, or any of these companies. The barrier to entry isn't that great, and the attention span of the consumer isn't that great. So I think avoid all these companies, and if you can, if you feel like it, short them. At the moment, the US market is being held up at its elevated level because something went wrong there. Very good. At its very elevated level because of the huge amount of money that's been created in the last few years. Now, the Federal Reserve, even under the relatively dovish Janet Yellen, has decided now is the time to ease back. So they will taper to the point of no further expansion in the US Federal Reserve balance sheet by the end of this year. They won't expand the balance sheet anymore, but I don't think they'll shrink the balance sheet, because by shrinking it, they probably put the economy back into recession. So we have the great tailwind of money creation coming to an end in the US. So why would you, on balance, unless you really selectively pick your stocks, be involved in the US market at the moment? It's a pass the parcel game, and we all know how those normally end with